Whether you believe it or not, it's Saturday morning once again. So, welcome back. Another weekly market recap. The economic calendar, as anticipated last week, was particularly light for the week we are about to review. So, we are just going to skip it right away and dive into the charts. So, let's start out with the dollar or the DXY. And so the first one we are going to look at is one of those which tells us that we were wrong, right? So we were anticipating a little bit of a continuation to the upside, while instead we had basically right away, opening up the week on Monday, the market just kept on going down, all right? Now, if you check the shape of the candles, these Monday and Tuesday down candles, they look particularly decisive, right? You see that there is a lot of body and a very tiny shadows at the extremes. So those should be your usual down days where the market just goes down with conviction. All right. Now the thing is, we had a little bit of a Thursday reversal. So Thursday, it just some sort of a pose or a stopping candle. It's not really an engulfing because it didn't trade above the previous daily high, but on Friday we managed to push to the upside a little bit more, and even on a closing base, we managed to close above the Wednesday high. Now, it's where it gets tricky a little bit in my view, because it looks like we just fell back below this previous level right here, which was reclaimed last week, as you remember. But on the other side, if you want to look at it and looking at the glass half full, what you could say is, well, at least we didn't have continuation to the downside, aka no lower lows so far. Uh, could this be your first higher low? I mean, you would need a little bit of more confirmation in my view. But if you want to build up a little bit of a more neutral slide slash bullish case, you could say, you know what, I have my first high low. What do I need now? My first high high. So trend reversal should be confirmed if we manage to close a daily candle above this high right here, the dip swing to the upside. On the other hand, I think given the fact that this is a currency, rolling out any major type of announcement or economic event, I'd say maybe what you want to do is switching a little bit more to the neutral side and expect a little bit of the same, like some sort of a rangy behavior, at least for next week, and then we'll see. Sure, the triggers for trend continuation or trend reversal are the same. So another low or a new high in this case, those would confirm continuation or potential reversal. But given how it traded this week, I would be more neutral than anything. And again, considering that we are coming off of a downtrend, when you say you're neutral, whether you like it or not, or whether you want to admit it or not, still the balance of probabilities should be still oriented toward the previous trend. So, neutral, but the trend is the trend. So up until the trend is not reversed or broken, yeah, let's just say I'm a little bit less bearish, but it's not that can be completely neutral. The trend cannot be ignored, right? So neutral, but biased a bit more to potentially another attempt toward the lows. Um, I still think, especially getting into August and September, that this market is setting up for a little bit of a bounce on a macro scale, but it takes time, so maybe it's not really the moment yet. But I will keep on looking for evidences that this market wants to stop a little bit from going down and having a little bit of a relief rally. All right, we'll see. So conversely, foreign currencies traded, especially the euro, traded with a little bit more of strength. Now, again, it gets tricky in my view because if you check just the euro, uh, yeah, it was particularly strong, right? Of course, no new highs, even in this case. But nonetheless, if you compare it to the pound, right? Uh, you see that especially on that DXY reversal on Thursday, the pound sterling that suffered a little bit more and it came back down toward the recent lows. The Japanese yen kept on being, in the context of what we are looking at in this price segment, still on the weaker side. And, as for the Canadian dollar, nothing relevant for now. We were anticipating that probably it was starting to form a range, and I guess it was in this segment right here. So far, we didn't break out of the highs, nor we broke down off of the lows. So yeah, it seems like a range has been confirmed. As for the Swiss franc, still grinding to the upside a little bit, so nothing changed in this one so far. Notice, and this is one thing I was discussing this week, that uh, you know you could have grasped the relative strength of the euro compared to the pound, because the previous week what we got was the euro coming down, right, pulling back, and using that previous level of resistance, now flipping it as support. And by doing so, meanwhile, what we got is the euro forming a higher uh, low compared to the previous dip swing to the downside. And instead, the pound actually took out those previous daily lows in this case. It was just by a tiny little bit, but it did. So your usual divergences and breaks in correlation, they keep on being particularly useful even on currencies, right? Now, as for the BRICS or the exotic currencies, if you want to call them that, nothing really changed. It's been a while since I didn't see a particular meaningful price movement in these ones, right? I mean, for instance, look at the Indian rupee. It's been in this range for what now? From April, basically, we had a deviation to the upside, a quick and sharp deviation to the downside, and we are still in the same range at the end of the day. The Brazilian real, especially if you zoom out a little bit, it's the one which looks more constructive to the upside, so it might reflect some, economic strength in Brazil relative to India, maybe. Uh, the South African rand, again, nothing to say. Russian ruble, we got that. I mean, at the time, it was looking like exhaustion, but we just fell back into the range. Usually, when you see it, it's not a good sign, right? You see some sort of a tailing range which is formed, a massive try to the upside, immediately uh, crashed or faded, and then it gets to trade in the previous dealing range, and when it starts hovering around the lows, that's your weakness type of sign. But the way this is trading and the fact that I'm not particularly familiar with currencies like the Russian ruble or pretty much all these ones for what matters, I wouldn't be particularly sure of anything on this one, right? The Australian dollar, it did kind of like what the dollar Canadian did, so it just started to trade in a new range. It's compressing. Still, it's grinding to the upside slowly but surely. But I still think among all the major currencies, yet this is the weakest for now, right? So let's move into oil, and we are kind of trying to break this range, right? We retested the low side of the range around 65. We bounced, but then Friday was a particularly bad day for oil. We came back down, and I mean, the close, it's not really enticing in my view, right? When you spend the entire week drifting down, you had a little bit of a bounce, which is immediately faded. And even on a closing base, you came to close not only really near the daily lows for Friday, but also the lows for the entirety of the week. So I don't particularly like this one. Still, as I said, I tend to be bearish biased on oil because of macro factors. global demand, global growth, and whatnot. But this week, especially from a price action standpoint, it just confirmed maybe a bit of weakness. Sure, sure. Up until the range is not completely broken, uh, just be aware you don't want to be the guy which is gonna short right around the potential range low. Therefore, you basically sell the bottom of this consolidation. So just wait for it to be actually broken, and then if it gives you a pullback, you might get in later on if you want to short it or play it to the downside. Oil, it's not a market that I do really trade, so I don't really care. I mean, I follow it because, as I always say, energy is the economy. The oil market is one of the greatest type of insights you can have in the energy market or energy demand globally. Well, I think, as we hinted in the past, that nat gas will become another one. I mean, it already is, right? Under many different perspectives. But I think there could be a flippening coming in into the future, or at least an arbitrage which is going to be closed in, right? I was a few months back when we were talking about energy, but I I'm, I don't have the time to go off of the entire thing right now. But if you check what's happening in China, they converted back a lot of diesel fuel trucks into nat gas fuel trucks. So there is just an opportunity to use nat gas, which is really abundant, really cheap compared to oil. And, it can also help you to diversify, or when you look at it from the standpoint of needing the access to a commodity which allow you to produce energy, and at the same time getting a little bit away, so de-risking a little bit from the Middle East and all the geopolitical risks that it could bear, right? So I think there are many different factors which could contribute to having this arbitrage being closed in, with oil diminishing in terms of demand and usage and whatnot, and on the other side, nat gas being propped up a little bit more. All right, up until the point the arbitrage is closed in, and at that point, the inefficiency has been rebalanced. That's what markets tend to do. If they find some sort of an exploit or a price, a mispricing, right, in the markets, they are going to use it in order to make money. Who wouldn't, right? It's just human behavior. So let's move on into gold. Even gold was a bit tricky this week, I guess. Look, the week at the end of it, now that we have just, went through a few charts, let me say the week was kind of non-eventful at the end of the day. Many different assets, they really didn't move a lot. Might be because of the economic calendar, so no major catalysts or news-driven type of movements. It could also be, as we've seen, summer trading volumes are a bit more, a bit thinner, so lighter volumes. Many different people would probably start to close down shop for the season. I, the only thing which keeps me monitoring these charts is the fact that with all we got going around in between wars, tariffs, the deals that still needs to be finalized in between the US and I don't know, Europe. This week we've seen Japan, right? So many different things could change, and apart from that, we are still now in the center of earning season. So I kept monitoring these markets, but I'm really not that much engaged in the entire thing right now. This week, for instance, I only traded on Monday. Then I had other things to do and taken care of for my personal business and company. But it's always nice to keep on following these ones because you never know what may happen. You can't just detach for more than a week. Because when you come back, you might come back to a completely different, at least narrative, right? So just gotta stay in the flow and keep following the news stream or the simple price action. And it just so happened this week that it wasn't particularly eventful, right? Now, what do I think about gold after this tiny little tangent is that, you know, we had what we were looking for in a way, right? This level was tapped into once, twice, three times, and every time the previous weekly low were remaining intact, and eventually we got a push to the upside. It was faded again, and we came back not only below that level we were looking at for the past 2 or 3 weeks, but really close to that previous weekly low. So now I think overall you could keep on being relatively bullish on gold, although the more it fails at making new highs, the more you could look at it getting into one of those boring ranging phase. Now, to be fair, that was one of the scenarios we were looking at, starting from here, I guess, was pretty much in here when we failed at continuing lower, if I remember correctly. You could object to this that if that was the case, we have been in it since the middle of May, basically. So it's already, what, almost 2 months, if not, no, three months. So at a point, the consolidation will see a breakout or a breakdown. I'm still, all in all, bullish oriented on gold, and my point of invalidation for these upside movement or momentum, it remains for now the June lows. Uh, in another week, probably it's gonna be the July lows, so these low right here, and you keep on raising it month by month up until the point something drastically changes. All right, so at the end of it, if you try to picture a trend line here, an horizontal trend line, and again a diagonal in here, still it's looking like an ascending triangle, which has not been broken to the downside. So I need to keep on being bullish biased. Although we got our points of invalidation for potentially a further movement to the downside, but up until the point it doesn't happen, the trend is the trend, the so to speak, the pattern, it's the pattern, and the fundamentals are the fundamentals. So it's hard to be bearish gold in my view for now, and let alone without any type of a price action confirmation for a potential flush to the downside, right? Let's have a look at Bitcoin, and even this one, no major surprises. Our main disposition last week was, look, the market, it's bullish overall. We just had a massive expand, well, massive. Let's just say it's relevant even for Bitcoin, right? Expansion to the upside. We had a little bit of exhaustion, right? It was 10 days ago, more or less. And, we started going into a range. I said, and I remember it, would you be bullish? Yeah, if you're looking at it on the medium, in the medium term, why not? This is a bullish market. Should we be bullish right away? And I said, I wouldn't be bullish over the next few days, right? Because we might see this market at least going into a little bit of a consolidation, building up acceptance, which is good, right? In the context of a market making new highs and starting to building up volumes above the previous highs. We could also have some sort of a pullback. I don't think this spike to the downside could be categorized as the pullback I was hinting at. I mean, I would expect something a bit more substantial. Uh, does it have to happen just because I'm expecting it? No, we have just seen on the DXY that I was expecting something, and we got something else coming. So, I'm just saying, the signature that I see here as for the price action, it's not really that type of pullback where you say a lot of people might have been shaken out. All right, that's what I'm saying. I would expect a bit more of a deeper pullback if you want to, shake out the weekends at the table on the long side of the book, and then, creating the liquidity to reaccumulate and keep on pushing to the upside. And again, does it have to happen? Does it mean that you can't really buy or add to your positions in this range if you don't see that type of public? No, it doesn't mean you can't. It just add a little bit of a potential risk of buying too high. All right, but the market will do what the market will do. So it could also be that these shadow to the downside, this sudden move to the downside, taking out these, kind of relevant low at the end of the day in the context of these, what, uh, 10 days of trading. If you see it starting to reverse now and printing a candle similar to this one to the upside and breaking and closing above the recent highs, then you might say that was enough and we still got the momentum. Never underestimate momentum, all right? Um, Especially if you're one of those which are looking at indicators like stochastics or an RSI and whatnot. Momentum can always last longer than what you expect or what your indicators would suggest. So, you know, I still think this is a market which is obviously oriented to the upside. It this week, at the very least, it behaved right as we were expecting it to behave, and so far so good. No major issues with this market. And quite honestly, if you want to kind of try to play the same game we were looking at for gold, where would you put your point of invalidation for this massive upside? I say, I mean, placing it below 98 at this point, it's a little bit too much. You would need something to tell you to start the risking a bit ahead of it. So I don't know. Let's just for the sake of it, you could take the sort of a base right in here, right? Kind of like that. And you might say, you know what? If we manage to pull back and break below it, so let's call it 108,000 more or less. It's more of a region than a precise price level. But if we break below this fractal and we erode all the liquidity which propelled and fueled this move to the upside, at that point, at the very least, you should expect a little bit of a choppiness below it and potentially a bit more of a pullback toward the 100K levels, right? But up until the point it doesn't happen, I wouldn't be worried about Bitcoin, right? So, that's it. Just ride the trend until the end of the trend, I guess. So let's have a look at yields. Yields, they didn't really go anywhere this week. I mean, if not, coming back down. And again, people will say what they want, and especially if you check the mainstream media outlets, right? Um, just because we had this massive week to the upside, and now we got a week to the downside. So overall, still the same range. Are we closer now, especially if you check the long end and the medium end? Are we closer now to 5% instead of 4 compared to where we were maybe 2, 3 weeks ago? Yeah, I mean the long end especially, right? But uh, do you look at it and you say something really and drastically changed? I don't know if I would say so yet. And we've seen we went through a little bit of a what was that? The 10-year, the latest 10-year auction, and we've seen that still there is a lot of demand for bonds. And from a price action standpoint, right, you keep having that divergence. The funny thing is, while the medium and long end of the curve came down a little bit as for the yields, instead the short end had a little bit of a rally, especially what Wednesday, Thursday, Friday. It might be because next week it's going to be FOMC. The market is pricing in no cuts as for now. If we check, let's say these, right? 96% odds the Fed fund is not gonna move. Although, what was the name of the gentleman? I guess it was Waller, right? Because there were two of them which were particularly vocal when it comes down to the need of the Fed, to cut at least 25 basis points. at the July meeting. It was Waller and the other one was Bowman, I guess. But again, Waller talked about it even this week. I don't remember the type of event, but it was, out in the public talking, and he laid out his view at the very least of why the Fed should cut in July. Labor market softening, slower economic growth, and all the rest. But what can I say? I guess I do like to be on the side of the minorities because I would agree on what he says, especially if you remember last year, right? Last year they didn't cut in July, and then they had to pause in August. And when they came back to the press conference or to the next meeting, if my memory is not failing me, and feel free to correct me, but I guess they cut like 50 basis points all at once, and they just spooked the market, I guess. So would be, in my view, even again considering inflation, it doesn't seem to be a problem for now. It's almost on target if you check the true inflation, right? So why wouldn't they cut? I'm not talking about cutting 100 basis points like it was an emergency meeting and something huge is going on in markets, but you know, 25 basis points, would it, first of all, would it make a massive difference, right? I don't think so at the end of the day, mechanically at the very least. Does it send the signal which you don't want to send, as in we are giving out on the quote unquote fight on inflation? I mean, surely it would send out the message that you came to the point that you're not worried about inflationary pressures that much. But on the other hand, you spend the last 5 6 months talking about tariffs, inflation, and whatnot. So why the sudden change of heart? uh, Sometimes I start thinking about it, and however I try to slice it, I keep on thinking they just cornered themselves in this trap, which was, you know, based on a wrong assumption, and now they can't just get out of the trap without again admitting that they were wrong before, which would, kind of put a dent in their credibility, and credibility is all they got. So you know the story from there. Um, if the market is not expecting a cut, and Waller and Bowman are kind of on the minority side on the FOMC, I would expect no cuts in July. So probably we are not going to see cuts. But that doesn't mean that even I share the opinion that they should cut. All right. But again, our opinions at the end of the day, they are irrelevant. They are gonna do what they're gonna do, and the market will respond accordingly. Right. Oh, as for the treasuries futures, they just traded, of course, inversely to the yield that we just had a look at. So let's just keep them, and let's move into stocks. I'm gonna try to record it all in one blow because I also have things to do, so probably not a lot of time for editing and all the rest. Now, the equity market, it started out with a boom, so to speak, on a Monday. Um, I don't really remember if it was because the Japan trade deals was announced and finalized, but there was some sort of a catalyst like that at the beginning of the week, but I don't remember if it was on Monday or Tuesday. Considering how the price moved, probably I would say Monday, all right? But look, and then we spent the rest of, at the end of the session, we basically gave it all back. And on Tuesday, we traded back below the Friday's lows, both for ES and NQ. Um, was a was interesting in my view to see that for a good chunk of the week, ES was actually stronger than NQ, as if the market was just trying to rebalance a little bit the breadth. All right, And I also think we had a little bit of a rotation in different sectors, right? There is another particular rotation which could be in play in the coming weeks, which it's in the healthcare sector. Healthcare has been particularly, beaten up. It's particularly weak now. It's particularly oversold. But you got companies in there which, at the end of the day, are not that bad. So I would expect money to just rotate. One potential headwind that I see on these kind of call it bet, short-term bet, if you want, is that the healthcare companies are facing a little bit of a turmoil when it comes down to the regulatory framework, right? So there might be something which could impair or at least give the impression that those future revenues could be impaired, right? So maybe that's why the market is a little bit hesitant in performing this tiny rotation into them, right? So just, pick your poison, I guess. But going on, we saw on Wednesday the market had a decisive push to the upside. And again, if you check the chart, just look at the box highlighted in blue. It's the Asian range. So what you got, it's ES not getting closer to the Asian lows, right? And then shooting to the upside. While instead NQ, it just took them out, but then it was completely reversed and actually it went for the highs. Uh, you know, established on Monday. Uh, of course, ES was already had already tested them, so it just moved even higher than that. Still, to give you a little bit of an insight in how useful it could be to check these breaking correlations, all right? So these divergences. If you can frame them in the context of a market which is doing XYZ, so basically, uptrend, downtrend, or consolidation. But, nonetheless, they can be particularly insightful in my view. Now, Thursday was a rangy day for pretty much all the three indices. The Dow was the one on the weaker side, Nasdaq weak a little bit, but not as much as the Dow. And even in this case, you check the structure on you see that on this sudden drop that we got around the New York Open, it was right. NQ and the Dow really came back down, but the ES futures they didn't they didn't come down any really anywhere near that type of magnitude. So ES kept on being the stronger. All of them pretty much, at least the main two of them, the Dow not so much, but ES and NQ managed to close the week really close to the highs. So again, the stock market is just going to the upside once again. And if you zoom out on a daily time frame, that's what you got for NQ, ES. The Dow again, although on the very low time frame, it wasn't looking like it was a piece of art. But again, if you zoom out, you see this push up, some sort of a rounded reaccumulation, and it's just following the rest of the market. As usual, as always said, I am not a particular fan of the, small cap, aka the Russell 2000. I don't see a reason to be invested in it or, to hold it. If you want to trade it, I guess, yeah, you could trade whatever, right? But again, fundamentally, there is a reason if it is constantly underperforming, right? I'll let you be the judge of what that reason could happen, right? But look, these markets are still fine. There is, from a price action standpoint, uh, I'm not going to repeat what I've said for basically the last 3 weeks, all right? So uh, instead of doing that, let's just try to, again, I think it's much more valuable to highlight the potential risks and the potential cracks which are starting to form in these markets. Bear in mind, again, as we were talking about the momentum, right? momentum, exuberance. Um, it, it, it can be dragged out a hell of a lot longer than what you expect and what the data would suggest. And again, you will always need a catalyst for momentum to shift. All right. So, just because we are about to look at some potential negative things, remember that, before putting money on the line, wait for the market to confirm something has actually changed. And again, will you be kind of quote unquote late if you wait that? I mean, it's better to be a bit late with a little bit of confirmation rather than being the one which keep on shorting the market every single day for the last 2 months, and every single day, you know, you get into profit for one day or two, and then it just blows you out of the water, right? So I guess that's another time when you are hear me saying pick your poison there. But let's have a look at these slides before wrapping up. What we see when it comes down to another sort of a seasonality measure, if you wish, we are looking at retail net flows. So could also call it inflows on the retail side for this market. And you see there is an historical type of pattern on a weekly base. And it's not a lot of history because it just starts in 2016, but almost 9 years at this point. It's I guess it starts to have a little bit of a statistical relevance, and especially if you want to look at it in the context of what the recent behavior on the retail side has been. All right, so a lot of gambling mentality, complacency, and all the rest. But you see that after July and getting into August, even the inflows from retail traders or investors, it starts to cool off a bit, which would line up to the fact that August and September, when you look at the seasonality from for the S&P returns historically, they tend to be two of the most of the weakest type of months when it comes down to average returns, right? So, bear in mind, it could be something which is worth paying attention to. Now, it is also true that if you check the free cash balance, so let's imagine this as available dry powder, right, or fresh liquidity on the sideline, which is just waiting to be deployed. What you see is that right now that type of metric it's negative, which means that essentially, as we were hinting at last week, maybe not everyone, but a lot of people which could have potentially bought already bought in. So again, who's left to buy, right? If they already allocated all the money they got, they don't have free cash balance right now, right? And if you see there is a good correlation in between this massive spike in this value going negative and potential pullbacks in markets. Now, does it mean that every single time it was a crash? Well, not necessarily, right? Like it could be maybe just a minor pullback. I know it sounds crazy to say, but given how the market moved over the last 2, 3 years, um, you know, 6, 7, 8% pullback is at this point in the current context, and it's not something which is really out of the ordinary. Now, I know after what we've seen uh, since the bottom in April, with a market which is just going up and up and up, even a 5% correction at this point would sound and look painful. But hey, just keep things into context at the end of the day, right? Now, what we got again, we were looking at this chart. I guess this was just updated, but still, I don't know if it's really up to date with the month of July, but nonetheless, I found an updated version of it, so why not? We already looked at this one 2, 3 months ago, maybe, but this is the margin debt as percentage of real disposable income. In a nutshell, it shows you how many people, or what portion of what people are spending on a daily basis, um, you know, because disposable income is what you get, right, as for income, and you can actually tap into it for, in order to face your expenses, right? I guess that's a better way to say it. So you're just looking at how much of that disposable income, which is then, spent out, maybe to pay your bills, to pay down your mortgages, right? To fix your roof if it's broken, to pay your food, right? The percentage of that which is represented by margin debt could be your credit card debt, right? So many people not having the actual cash flow that they need to face their obligations on a month by month base, so they're tapping into debt in order to be able to face those obligations. I guess it's never good when you need to tap into debt to face your fixed expenses. Don't get me wrong. I don't hate debt. I guess debt it's wonderful if you can take it up to finance something which is gonna be productive in the future. It's not a good thing if you need to take on debt in order to finance your current expenses. Those should be just taken care of by your revenue or regular income if you got a paycheck or whatnot, right? So not a good sign. And even in this one, you see that those times where this metric really went to the upside, the market just we got the dot com, we got the financial crisis, we got COVID, of course. So we'll see what's next, right? But might be just another warning sign. All right. Uh, Getting back on the topic of exuberance, I guess this chart just speaks for itself. Looks like we are back to those times, the times of GME, AMC, meme stock, Hello Kitty, and whatnot. These 0 day to expiration options are just taking the throne when it comes down to the retail uh, activities in the market. Truth be told, I think there is a place for options, especially when it comes down to hedging your positions. But the way people are treating them, it's it's more like lottery tickets, right? Now, this is good for now because the market just it keeps on going up and up and up. But so was throughout 1998, 99, 2000, and but then we got 2001 and 2002. So it never ends well for retail, for the retailers which are trying to play this game in the long run. Yeah, sure. I mean, you're gonna hear the story of that guy or that guy which made a fortune and actually became a millionaire. The stories that you're not gonna hear probably are those of the people which either lost everything or made a lot of money, but since they were complete amateur and they didn't understand anything about market dynamics, they made a lot of money when the market was going up and they ended up losing all what they made and then some when the market came crashing back down. So, if history is a good teacher, it never ends up well, right? And let's have a look at sentiment for a minute. Now, I I said in the past, sometimes sentiment, especially maybe it's more oriented to macroeconomic data and surveys, but I'm not really focused on sentiment. All right. But, it's undeniable that when you got the so-called dumb money, which is a definition I don't really agree with, like smart money, dumb money, um, I, I don't know. Let's just call them like professionals, right? And retailers, right? So in red, you got the dumb money, aka the retail traders or investors, which, by the way, if you check the recent market V shape, the retailers are the ones which bought the dip and are making a obscene amount of money, while the so-called smart money, they are the ones which are actually lagging and needed to catch up. So I don't know. It looks like sometimes the two roles could be reversed, right? It's just the beauty of markets. So historically, though, it's undeniable then when the dumb money or retail investors, traders, they were particularly optimistic, exuberant, bullish, I already said optimistic. So you got it. Sentiment was particularly high. The market tended to had a little bit of a pullback. Now, it's hard to appreciate the scale of the pullbacks on this chart, but I guess it's just to highlight the direction, or at least the dynamic of what happened, right? I marked them off with a X on the chart, so you can just look for yourself what happened when sentiment was particularly high in the past. And it's a good, we are not talking huge macro reversal or potential bear markets, especially because we are looking at only what less than 3 weeks of price action. But we are just trying to look at it in the context of potentially anticipating a little bit of a weak phase in the market after these huge advances. There will come a time when you need to pay that back a little bit, right? So it looks like sentiment is particularly high now on the retail side of things, and it's particularly low on the professional side of things. So again, it might be that we we could see again with with a decent catalyst, we might see, considering the seasonality, at a point over the next 2 months, a little bit of a correction. Nothing, it doesn't have to be a crash again, but maybe, your 5, 6, 7% correction. Guess it would be enough to scare out of the markets a lot of people at this point. But there's a reason why retails they keep on being particularly optimistic. Now, this is a chart which basically tells you what would be the cumulative return, right, from the start of the year, considering, just for the current year, right, so to speak. So taking the data set year by year, right? If every time you had a down day in the Nasdaq, you would have bought the dip, all right? So the last column right here is 2025. So starting out in January 2025, if every time you've seen a down day on the Nasdaq, you would have bought it and you would have held it throughout the next session, so very short term, right? Your cumulative return at this point, in mid-July or whatever you, or the end of July, would be 29%. And this is the second on record getting back to 1985. It was just beaten by what? Oh, I guess this might be 2020 by the look of it, right? So you see why retail traders are particularly bullish, because buying the dip, it was a strategy which paid them. And again, it ties back in with market exuberance, momentum. It's gonna work, and it might work for another through 2 months, 6 months, 1 year, or whatever you never know how long it's gonna work. What you know is that when it stops working, it becomes really messy. So again, just a little bit of a piece of statistic there. It's not the same magnitude as for the S&P if you check the same metrics. So again, if you got a down day, just buy the dip and hold to that position until the end of the next session, right? It's just, I guess, what the fourth uh, high on record. So still on the higher side, but not as incredible as for the NQ or Nasdaq data, right? Now, a lot of people often talks about the credit default swaps. Now, it's just another metric to measure the type of appetite for insurance, right? So the perception of risk inside either the system or the market. So uh, if you think of, for instance, the what was the credit spreads, right? We have been looking at them sometimes, and I'm referring to this one right here, right? So, of course, when they are low, that's good, everything is fine. When they spikes, there is a little bit of a scare in the market, right? And everyone is trying to ditch a particular type of credit and to get in a something which is a bit more safer, right? Now, it kind of works the same. It's just if you know what the credit default swaps is, uh, it's just an insurance on, of course, a default of some specific credit related instrument. So naturally, if you see this chart, which is an index, by the way, if you see it going up, kind of like the credit spreads, that just tells you that many different people are buying into CDS, right? Why would it be? Well, because they just want to hedge themselves and protect themselves in case of a potential risk of default somewhere. Now, considering the fact that this is coming down particularly sharply after the April, I guess it was April right here. Yeah, the April scare, the tariffs, the Liberation Day. Um, it looks like if you zoom it out and if you check how the stock market behaved relative to this one, it's no surprise that when he was going particularly and sharply, to the upside, the stock market was suffering. And when it was cooling off, the stock market was recovering, of course. So those periods where this index on credit default swaps was actually coming down, they were basically coinciding with bull market phases on the overall market. We are just looking at the benchmark right here, right? So that could be another thing that you want to check. The funny thing, or at least the useful thing of checking these out, so the CDX, right, or the CDX, should I say, checking this one instead of volatility might be useful for you because historically, if you if you look back, there are many different iterations, there are many different periods where these index actually anticipated the VIX. So the VIX, the fear index, right? Uh, when do you see the VIX spiking to the upside and conversely the stock market plunging? Well, when something is going wrong, of course. So the point is, if you wait for the VIX to actually spike, it might be too late. The plunge that you were fearing already materialized itself. The good thing with an index like this historically is that there have been many different periods where this type of movement to the upside actually started before the VIX started to going up. So it could be a little bit of a leading indicator, if you wish, when it comes down to assess risk, right? So, I just thought I would have thrown it up there, right? And from a positioning standpoint, I guess what we see here is that CDAs, so computer trading algorithms, they are particularly allocated right now. So they bought, and they're coming up into the 90% percentile. So there is a good amount of exposure even on the CTA type of you know on the CTA side. Let's call it like that. Is it important? Well, CTAs, they tend to trade on momentum. So if the market goes up, they keep on chasing it. It's important to kind of track what they're doing because if you see they're pretty much all on the buying routine and they have bought and bought and bought, since they are based on momentum, when you see a momentum shift, those CTAs will be particularly quick in shifting their own routines and starting to sell, which in this case, if you imagine it, it would just fuel and exacerbate a potential pullback, right? Remember, they don't know what's going on. They don't know if there was some sort of a fundamental type of a change in markets. All they know is that they do trade the tape, right? They do trade the momentum. On once those routines are triggered, they're not going to pay attention to Powell. They're not going to pay attention to Trump. They're just going to follow what the market is doing and where pricing is going. So they're just momentum trend followers and momentum followers, so to speak. So as soon as you got a shift in one of those two components, and these machines are particularly, out of balance or overexposed one way or the other, they will quickly try to rebalance what they just did for the previous period. So always remember that, right? Now, let's end up on a positive note. We have discussed how corporate share buybacks have been one of the main and key factors in order to provide buying pressure to the equity market. So it looks like, August is a good month for corporate share buybacks announcements. So, after we come off the earning season, the buyback window will be open up once again. Right now, of course, we are still we're still going through earning season, so a lot of different companies they are in the blackout window. Okay, so I guess it's another reason why you could keep on being bullish. Now, remember one thing though, just because many different buybacks has been or have been authorized, it doesn't mean that they can be suspended. Right? So let's say Google all of a sudden, if Google sees the market plunging like it was in after Liberation Day, would you think they would keep on buying back their own shares if or at least if they know, if this market it probably gonna be another 2-3% lower tomorrow or next week? Well, they're not stupid, so of course they would wait for the market to give signs that this is an advantageous point at which you can buy back your own stock, right? Now, closing up, thinking and talking about earnings, it could be a major catalyst. We just had last week, we got Tesla and Alphabet reporting earnings, and next week we are gonna have, I guess, Microsoft, Meta, and the day after Amazon and Apple. So look, I'm not really following earnings. Sometimes if I really got the time, I started and read some earnings report, by especially by the Max 7, right? Just for the sake of it, okay? But I'm not really one of those which are looking at earnings, trying to dig in every single detail of the report and whatnot. I keep a broad and general eye on them. Like I just look at, did they bid? Did they not bid? Did they disappoint? Or are people talking about a particular aspect which was particularly disappointing or maybe particularly enticing, right? But I'm not huge in earning reports and analysis. I can just notice the fact that, as we discussed in the past, earnings expectation as forward projections were revised lower, so it was easier to beat the expectations, of course. Now, I've seen that after these first 2 weeks of earnings, those forward estimates have actually been revised higher for Q3 and Q4. So on one side, that could be a boost in confidence for markets. On the other side, it could be the catalyst if we are going to see, again, remember August, September, weak months, right? If you're going to see a little bit of a miss in those freshly upward revised earning expectations, and then we come into September, October, and we start to have a bit of misses, right? So for now, I wouldn't say I see a risk. Actually, if anything, I see a boost in confidence since they are revising them higher. Um, the I'm expecting at the end of the day that we are going to have something like 80% plus type of bid rating, considering how they were revised lower previously. And again, it's just the usual Wall Street game, right? What do you need in order to pump a stock up? Well, it would be particularly good if they can beat earnings expectations. Oh, gee, and how do we do that? We can't really impact the revenues of the company, but you know what? We could just, you know, um, redirect or quote unquote ask our dearest analysts to revise those expectations or forecasts lower. So, I mean, we can't really impact the revenues or the earnings of the company, but we can help them beating by setting up the bar lower, right? So win-win for all of us. So I guess, yeah, again, that's how the game works sometimes, whether you like it or not, right? So that being said, got anything else for you today? So I'm gonna leave you off, and again, up until next week, be nice and be cool. Take care, and as usual, we are gonna talk next week, another time. Up until then, you know, I'm probably gonna be a bit more hands off because we are getting into August. I mean, you gotta take a break at some point, but I'm gonna keep on following the markets nonetheless, right? Few minutes a day doesn't really spoil your vacation, right? So be nice and be cool. Neil's out.